Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. And let's start with the really nice week in equity momentum, and it's capping off really the start or a little more than halfway of a really strong third quarter. A lot of equity indexes making new all-time highs. We're also encouraged by market breadth, so we'll talk a little bit about that. But if you're looking for something to be a little bit skittish about, labor market data continues to disappoint and increasing those odds of a Fed cut next week. And then as we look at bearish sentiment from retail surveys that we observe, we've never seen stocks peak when we have bearish sentiment as high as it is right now. Now, on the chart here in the blue, we have the New York Stock Exchange Composite Index, and in the teal, we have the NYSE Cumulative Advanced Decline line. You can see both of these are at all-time highs. We had several different equity indexes make new all-time highs this week, but what's also encouraging is stats like that cumulative advanced decline line. That is a market breadth statistic which measures how much participation, right? How much support does this market have outside of just the big Mag 7 stocks that we always hear about? And the answer is quite a bit. There is good participation from small caps during the quarter. They're only 1% off their all-time high that they made back in the fourth quarter of 2021. So if they are able to overcome that hurdle, that's a good sign. And this tells us it's a running tally of the number of advancing stocks minus the number of declining stocks. And when that's moving up, that tells us that we have a lot of broader support and participation for the equity market. And that's a good sign for this overall market. Now, from a macro perspective, when we look at the labor market data that just came out during the month of August last week, we had 22,000 new jobs added in August. That was below expectations. We just look at this most recent Thursday weekly jobless report where we get the number of unemployment claims that were submitted by U.S. Citizens. We see those jumped up to 263,000. That's the highest since October 21. And it was just a trio of bad news as the Bureau of Labor Statistics came out and said, hey, we under or over reported the number of jobs over the past 12 months. In fact, it's 911,000 jobs lower. That was the largest revision we've had in more than 20 years. So revisions lower, unemployment claims higher, new jobs lower. All that means labor market definitely weaker than we thought it was, has started weakening more this summer, and that increases the chances of a Fed cut next week. Markets pricing in 100% probability. Some are saying maybe a 50 basis point cut. I think they stick at 25 basis point cut and give us two more 25 basis point cuts before the end of the year. Now, the American Association of Individual Investors is a retail investors club that has over 200,000 members in the US. And once a week, they survey their members and ask them, are you bullish, bearish, or neutral on the stock market over the next 6 months? And you can see the past 4 weeks of responses along with the long-term historic average since they started asking this question back in 1987. And this Thursday morning, we received the report, and you can see the number that jumps out to me there is that 49.5% red bar. That means 50% of respondents are bearish on the stock market over the 6 months, despite the fact that the market made a new all-time high this week. When you look at the long-term average of 31%, that means people are 20% more bearish than they typically are over the long run average for this poll. Now, what does this mean for the stock market? We view this from a contrarian point of view. When I say contrarian, I mean when you look at major market tops historically, they are typically surrounded by complacency and optimism, not fear and pessimism. And there's an old adage on Wall Street that says markets climb the wall of worry as that negative sentiment is unwound and put to work in the form of new cash flows. And we look back at all the major market tops on this chart since 1987. We have the 87 crash, the tech bubble in 2000, financial crisis in 2007 through 09, COVID, and the most recent bear market in 2022. On the chart here, we have the average, or not the average, but the percentage of respondents at that market peak that were bearish on the market. And it becomes pretty clear here that typically at market tops, the percent bearish from this poll is much lower. If you calculate the average across those five, it's 26%. At 50%, the stock market has never peaked with retail sentiment this bearish. We're about 2 times the typical bearish sentiment that we normally see at market tops. You typically see much more optimism. I think you put this in the category of something that supports a continuation of this uptrend. Now, a lot of talk about AI, but I feel like 3D printing is doing some pretty cool things in terms of their category of emerging technology. In Martha, Texas, a construction company announced that the world's first fully 3D printed hotel is being built using a special cement-based material within that printing machine. That printer on site is about 47 feet wide by 16 feet tall. You can see a picture of kind of these cylinder-like rooms that they're building. Pretty exciting what they're doing. If you talk to some of the construction manager, the quotes and the research there, they're really amazed at how little constraint you can have when it comes to 3D printing that you typically have with traditional building materials of brick and mortar and wood and things like that. I will be fascinated to see how this continues to evolve over the next 10 and 20 years. A lot of talk about AI. I think 3D printing might impact some of the construction industry in ways that we can't quite foresee just yet. So I'm excited about those developments there. With that, I want to thank everyone for watching, and I'll see you next time.